Do you ever feel completely swamped by just the sheer volume of information hitting you daily? News alerts, research, endless articles. Trying to figure out what truly matters can feel like a full-time job.
Well, that's exactly why we created the deep dive as sort of your shortcut to clarity. Today, we're delving into the fascinating and often turbulent world of EU carbon allowance prices, EUAs. We're looking specifically at February to August 2025, and this isn't just about tracking numbers. It's really a journey into how massive global events, unpredictable weather, and even, human psychology weave together to shape a critical market.
Exactly. And our mission here is to help you untangle this intricate dance of market dynamics.
Right.
We're going to unpack the surprising factors that drove some really significant volatility in EU carbon prices. Want to give you a nuanced view of what was truly important in the sources we looked at. You'll gain insight into how seemingly separate things, from short-term weather forecasts to the looming threat of international trade wars, can create those real aha moments in market analysis. Okay, so let's start at the beginning then. Early 2025. What did the initial landscape look like for EU carbon prices? What forces were already setting the stage for change?
Well, what really stands out here, I think, is how disproportionately the market reacted to something as basic as weather forecasts. It just highlights how sensitive these carbon allowances are to immediate energy demand. For instance, in February, we saw EUAs jump nearly 1%.
Just on weather.
Yeah, on predictions for colder weather, which, would mean more thermal power generation needing allowances. But then, as revised forecasts predicted milder weather, prices were quickly dragged back down. The December 2025 benchmark settled at 82.59, but the actual price hit 81.62. And that warmer outlook, it immediately created a broader bearish, sort of negative sentiment.
So weather was a big factor right out of the gate. What else was pulling prices down in those early months?
A major influence, this comes up again and again, was the strong correlation with gas prices, specifically TTF.
TTF, right? The European benchmark.
Exactly. It's a key indicator of energy costs.
Yeah.
In mid-February, falling gas prices were really the primary driver behind a 4% weekly drop in EU carbon. That pushed benchmarks down to 80.29 for December 2025, and even sharply lower to 78.05.
Okay.
And this trend, it just continued into March. EUAs consistently tracked TTF lower. That contributed to settlements like 77.21 and then 75.74 by February 19th.
That connection to gas prices is definitely clear. But what about the bigger picture, geopolitics? Were there any surprising shift on that front that played a role?
Absolutely. There was this optimism, maybe brief, about an end to the war in Ukraine, especially after President Trump announced talks with Putin. Now, that reduced what we call risk premiums across markets.
Those extra costs built in for uncertainty?
Precisely. Think of it like that. With less geopolitical risk perceived, those premiums fell. And this, coupled with the falling gas prices and the warmer weather, well, it really painted a declining outlook for EU carbon.
That significant drop, it suggests a major reevaluation, doesn't it? Was this purely a correction, do you think? Or were there other, maybe deeper structural issues that the market was finally acknowledging?
That's a really important question. Many analysts felt that the rally, the one that pushed EUAs over €80, was perhaps unwarranted, like prices had gotten ahead of themselves.
Okay.
So the subsequent drops seemed like a natural correction, back to what many considered fair value for the allowances. By early March, we actually saw the largest one-day fall in 11 months. EUAs dropped 4.3% to settle at 68.50.
Wow.
Yeah. This risk-off attitude, where investors pull back from riskier assets, it really took hold across both carbon and the wider energy markets.
So the market was reacting to trader sentiment, clearly, but for those of us maybe not tracking commitment of traders day to daily, can you quickly explain what that is? And what does net long positions tell us about how traders were betting?
Sure. Commitment of traders, or COT, data essentially shows us how professional investors are positioning themselves. Are they betting on prices going up or down? And it was quite revealing in this period. Initially, investment funds actually increased their net long positions.
Meaning they were betting on prices rising.
Exactly, buying more contracts than selling. They built up over 60 million of these long positions. However, as the market started to decline, they began reducing those positions fast. By late February, their net long exposure was cut by 8.3 million. That's a clear sign traders were, diluting, lessening their bullish bets.
Okay.
And this continued right into March. Funds cut another 8 million EUAs. They dropped their long bets by 20 million over the whole month. So even the best efforts of bullish traders to defend that €80 level, well, They weren't enough against these strong underlying fundamentals.
Right. So after that initial turbulence, driven by market dynamics, weather, trader bets, just as people might have thought they understood the game, April brought a completely different storm. What happened then that just overshadowed everything we'd seen so far? It sent the market reeling, didn't it?
It really did. This is where the broader macroeconomic picture completely overwhelmed any carbon-specific fundamentals. Fears about new Trump tariffs, taxes on imported goods, and an escalating U.S.-China trade war weighed very heavily on all markets. And this caused significant drops in carbon prices. Why? Because there were immediate concerns about cuts to industrial output.
Less industry means less need for allowances.
Precisely. So, for example, in early April, EU carbon prices plummeted 8% to a 2025 low. They hit 66.06 and even touched 63.
That's a huge point that these external macro factors can completely override the internal market logic.
Yeah.
Does that imply a fundamental shift in how we should even analyze these markets going forward? Or was it temporary?
Well, that's the million-dollar question, isn't it? This period was definitely characterized by extreme nervousness among traders. We saw a 5 trading range in a single day in early April. That was the highest in a year. It just highlights the extreme volatility. And what's really fascinating here is that during this time, analysts observed, and I'm quoting, that all short-term price forecasts were blown out the window.
Blown out the window.
Right. It became abundantly clear that EUA prices were just tracking these wider macroeconomic drivers. It made carbon fundamentals, even established technical trading levels, largely irrelevant in the short term. It was like the market suddenly stopped listening to its own internal signals and just reacted solely to the global economy headlines.
How does a trader even navigate that kind of environment? So unpredictable. What did their sentiment tell us then?
Well, the sentiment reflected that massive uncertainty. The COT data in mid-April showed traders' views were evenly split.
Between long and short.
Exactly, basically a standoff. The market remained range-bound, stuck between a high and low, completely bound by uncertainty about what macroeconomic event might hit next. And despite a brief return of confidence when U.S. tariff increases were paused for 90 days, short-term price targets became less about the actual supply and demand of carbon allowances and much more about wider macro sentiment and, trade tariff uncertainty. Investment holdings stayed finely balanced, and liquidity, how easily you can buy or sell, was often quite subdued, especially around holidays. People were nervous.
Wow, okay, that period sounds incredibly volatile. A real roller coaster. So after that wild ride driven by trade wars, did the market manage to find its footing at all, or was it still just bouncing around?
We definitely saw attempts at stabilization, but volatility remained a constant companion. There were temporary rebounds, for instance, news of an interim U.S.-China tariff reduction deal. That created a sort of positive macroeconomic outlook that traders quickly jumped on. EUAs added 4.3%, back up to 73.41 in mid-May.
A glimmer of hope then.
A glimmer, yes,
Yeah.
but short-lived.
So what new geopolitical tensions emerged to challenge this fragile stability?
Well, the market continued to be highly reactive to geopolitical headlines. Anything could move it. Concerns about cracks in French nuclear reactors in June, for example, that led to gains in natural gas prices.
And because carbon and gas are often linked.
Exactly. That helped EUAs rebound to 74.37. Then, escalating tensions in the Middle East also spooked markets. Initially, that pushed both gas and EUAs higher. EUAs even broke above €75 mid-June.
Okay.
However, then hopes for a U.S.-supported ceasefire quickly caused prices to drop again. The market recognized this risk of demand destruction from conflict, meaning less industrial activity, less demand for carbon.
It really sounds like that relationship between carbon and gas, which seemed so strong earlier in the year, was starting to get a bit complicated.
Indeed, that was a significant development. The correlation between carbon and gas breaking down. It was like two dance partners who usually move in perfect sync suddenly doing their own thing. In June, despite TTF gas prices actually rising, EUAs fell. They lost 2.5% in a single day. They settled back into what analysts described as their favored range of €70 per thesis.
Interesting. So why did that happen?
Well, it was partly attributed to aggressive selling, maybe profit-taking, and also a correction to the recent surprise jump up towards 76. But fundamentally, it meant traders couldn't just watch gas prices anymore and assume they knew where carbon was going.
Beyond the daily fluctuations and these geopolitical shocks, were there any policy developments from the EU itself, things setting the stage for the future?
Absolutely. You always have to watch the policy side, too. Key announcements continue to influence longer-term sentiment. The EU Commission reaffirmed its commitment to launching the ETS2 allowance market in 2027.
That's the new one for buildings and transport.
That's the one. And ICE, a major exchange, even launched ETS2 futures contracts back in May, anticipating this. Then in June, the proposal for the Green Claims Directive was withdrawn. That removed some potential compliance costs for businesses, which maybe eased some pressure. And then in July, the big one, the long-awaited official proposal for the bloc's 2040 climate target was published.
The 90% reduction target?
Aiming for 90% emissions reduction by 2040, yes. And importantly, it included provisions for using Article 6 international carbon credits.
Allowing emissions reductions transfers between countries.
Correct. And also an explicit statement to include domestic permanent carbon removals in the main EU ETS eventually. Yeah. So yeah, a lot of future-proofing happening, even amidst all the daily volatility.
So a real mix then. External shocks, shifting correlations, and these underlying long-term policy signals. How did the market actually behave through all of this, especially as we moved into the summer months? Did things calm down?
The market frequently exhibited what you could call yo-yo trading behavior, just bouncing within recent price ranges. By late May, EUAs were actually stuck at a pretty tight €70, 74 range for 4 consecutive weeks.
4 weeks? Wow.
Yeah. This summer slumber, as some analysts called it, continued into July and August. Prices often just clung close to that €70 mark. And liquidity also reduced, as you'd expect during the quieter summer months when traders go on holiday. That led to more subdued trading overall.
Almost like the market took a vacation itself?
You could say that, yeah. Less energetic activity, definitely.
And what about the traders themselves during this summer slumber? Were they still cautious, or were they starting to make bigger bets again?
Sentiment showed cautious bullishness, but also a lot of hesitation. The Cuddy data continued to show finely balanced views for a while, then gradually increased net long positions among investors again. For example, in May, these increased net longs did help push prices up a bit. By August, Cuddy reports consistently showed an increase in net speculator length in EUAs. So speculators were providing signals about the longer-term price outlook, maybe seeing value around €70.
But they weren't acting decisively.
Not really. Low daily trading volumes often reflected hesitation. Funds weren't building significant new positions. Traders showed little interest in really testing new price levels, higher or lower, during these range-bound periods. It felt like they were waiting for a stronger signal, catalyst.
So, okay, let's pull this all together. What does this mean for you, the listener, trying to understand this complex market? With all these different influences, weather, gas, geopolitics, policy, trader psychology, how do traders actually make sense of where prices might be going? What tools do they use?
Right. Well, traders and analysts use a blend of tools. Technical measures combined with fundamental and macroeconomic factors. For instance, key price levels act as important psychological and technical barriers or supports. That 80 level, remember, initially propped up by speculators, but it eventually gave way, leading to that natural correction. The 70 level was absolutely crucial as support. It was repeatedly tested, defended, often acting like a magnet for prices, pulling them back. When EUAs fell under €70 for 2 months, analysts started calling them oversold.
A signal for a rebound.
Exactly. Traders quickly used that as a signal. Then the 75 level, on the other hand, was a key target and resistance point. It proved really difficult for the market to sustain prices above there for long.
Were there other technical signals they paid close attention to beyond just those round numbers?
Oh, yes. Moving averages were frequently referenced, the 200-day moving average, for example. It often provided support for a technical bounce. And breaking decisively above it was seen as indicating strong bullish momentum. Option expiry levels also played a big role.
How so?
Options are contracts giving the right to buy or sell at a certain price, the strike price. When there's significant open interest, lots of outstanding contracts at specific strike prices like 70 or €75, that can almost define a trading range leading up to the expiry date, like gravity pulling prices towards those levels.
Interesting.
And as we've discussed quite a bit, that cut data provides crucial insights into speculative sentiment, signaling the longer-term price outlook.
And this feels like the big but. You mentioned earlier that these technicals weren't always reliable, that they could be completely overridden. So when did they not work and why? That seems like the critical nuance here.
That is absolutely the critical nuance and the challenge in this market. While these technical tools are used extensively, their predictive power was frequently disrupted, just thrown off course. Broader macroeconomic drivers like those Trump tariffs and the escalating U.S.-China trade war often completely outweighed technical analysis. It made both the carbon fundamentals and the technical trading levels largely irrelevant in the short term.
Like trying to read pond ripples during a hurricane.
Exactly that. A good analogy. Similarly, geopolitical developments, the war in Ukraine, Middle East tensions, frequently just dictated price action. You'd see trading algorithms reacting aggressively, instantly, to news headlines. And even that strong correlation with gas prices, while often reliable, showed instances of breaking down, meaning the gas market dynamics didn't always predict EUA movements. So you really couldn't rely on just one playbook. You had to watch everything.
So what can you, our listener, take away from all this complexity? Why should the volatility in EU carbon prices matter to you, even if you're not directly trading them?
Understanding these dynamics is crucial, really, because the EUA market is a key living instrument for decarbonization policy. Its price directly reflects the perceived cost of emitting carbon, and that impacts industrial output, energy costs, investment decisions right across Europe. So for you, whether you're prepping for a meeting, maybe catching up on a field you follow, or you're just, intensely curious, seeing how interconnected these forces are provides a really vital perspective. It highlights this complex interplay between environmental policy, economic health, and global politics. It's a prime, living example of how you can manage information overload by identifying the key drivers and understanding their relative influence at different times.
What an incredibly detailed exploration of the EU carbon market. It's so clear that from February to August 2025, EUA prices weren't dictated by any single factor. It was this complex, dynamic interplay of macroeconomic shifts, geopolitical events, fundamental supply and demand, and yes, the ever-present psychology of traders.
That's absolutely right. The market constantly shifted. There were periods where technical levels provided boundaries, sure. Then there were times when gas prices clearly led the way, and then moments when huge global events like trade wars and geopolitical tensions just completely overshadowed everything else. And underneath it all, the constant evolution of trader sentiment, which we saw in the COTI data, often provided underlying signals. But even that conviction could waver instantly in the face of major external shocks.
This deep dive truly illustrates just how interconnected our world is, doesn't it? How quickly one seemingly unrelated piece of news can ripple through global markets like this. It also really underscores the value of looking beyond the headlines to understand the true drivers of change.
And that leads us perfectly to our final provocative thought for you to consider. Given this incredibly complex web of drivers, where global politics, economics, environmental policy are all tightly intertwined, what future global event, perhaps one entirely unforeseen today, might be the next thing to unexpectedly reshape these carbon markets?